Hi, I'm Nick Stebbing, Chief Operating Officer at Fairstone.
My name's Ollie Stone. I'm the Investment Director at Fairstone. So I head up the portfolio management team and the operations team.
Why do we focus on investing rather than saving? I think to some extent we focus on both. It's important to continue, whilst you're in an accumulation phase, to contribute towards your savings pot, typically your pension. But once you've done that, the impact of the investment solution can be significant on you meeting your goals and the value of that pot at the point at which you decide that you want to start drawing down. The risks of not investing are quite significant for individuals. Over the last few years, we've seen inflation hitting north of 10%. That means that if you were to take a pound and put it under your bed and a year later still have your pound there, that might be worth only 90p. Now, over a 40-year investment cycle, that can be really significant. The purchasing power of that pound will have gone down quite significantly. So how do we mitigate that risk of inflation? Well, you can put money into a bank account, and typically you will get a return that is hopefully equivalent or slightly better than inflation over a multi-year period. We see the Bank of England moving rates around for that purpose. Or you can invest into what we call fixed income, it's debt, and that will, based on historic norms, that will give you a slightly higher return. Or you can invest into an equity-dominated portfolio. And again, what we've seen over a typical 20-year cycle is that equities will significantly outperform debt and cash, and therefore significantly outperforming inflation. So what does that mean for you as an investor? That means that when you come to use your pot, those gains will be significantly more than if you held it in cash, and certainly a lot more than if you put it under your bed. If you put a pound and invest it into equities, you would typically see, based on historical norms, over a significant period of time, that when you come to retire, you have a higher return and have more money than you would do if you held debt or cash, or certainly than if you put it under your bed.
Yeah, starting early, incredibly important so you can harness that power of compounding. And so compounding is sort of the snowball effect in investing. And it occurs when you are able to reinvest your investment returns. So that could come in the form of dividends, perhaps from equities, or interest from cash or fixed income. You reinvest that back into your investment pot, and it starts to gain returns on returns. So think of it like a snowball rolling down a hill, getting larger, increasing in size as the snow collects on it. And the best way to harness that, very, very simply, is to invest with a long-term mindset, so invest for a long period of time, be patient, and the more you're able to do that, the longer you're able to do that, the more your wealth is likely to grow.